Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. There's just an hour to go till the closing bell, and stocks lower after President Trump threatened Canada with a 35% tariff on its imports to the U.S. and floated higher blanket levies on most trading partners. Let's welcome in here our team coverage. Got Jay Woods, Freedom Capital Markets Chief Global Strategist, as well as our Washington correspondent, that would be Ben Werschel, and Yahoo Finance's Senior Business Reporter, Inez Ferre, who are all joining us throughout the show to break down the headlines. Ben, let's start with you. What is the latest with the deals? Who is set to be impacted here?
Yeah, the big letter we're going over today is Canada. This was a surprise that came in late last night from President Trump, and it wasn't even a country that was sort of necessarily in focus this week. They sort of seemed to be on a different timeline. Canada was, and so some of the up and downs we've seen this week is partly because we've been going through the nitty gritty of what Trump is promising with a 35% rate on Canada. The White House official offered me some clarity earlier today to say that this is a move from 25 to 35% on certain goods. Other goods that have been excluded before are going to continue to be excluded. This is key because USMCA compliant goods have a very much lower rate. Some have 0%. So those are expected to continue to stay at 0%, as well things like oil and fertilizer known as potash, which are key issues. So the Canada piece was a surprise, but a lot of the details suggest that this is a rise uncertain. The other big theme of the day is essentially a non-event, which is Europe. We've been waiting all week for some sort of sign on what's going on with the European trading talks. This is by far the biggest economic shoe to drop. This bloc is America's biggest trading partner by far. Trump first promised a deal Thursday, or a letter by Thursday. Now he's promising a letter today, but we still haven't seen it come in yet. So that's a big one to drop. But either way, it's kind of a disappointing end to the week that began with a sense that there could be a deal on Europe and good terms there. But it's clearly sort of pushing ahead to this new August 1st deadline.
And Ben, we did get some new fresh data this afternoon. I want to run it by you, get your reaction. Per reports I see here, Ben, on this very issue, Treasury Department recording $27 billion in customs duties revenue for June. And they say bringing fiscal year-to-date inflows from levies to $113 billion. What do you make of that, Ben?
Yeah, so this was expected that we were going to have big tariff revenue for June, and we've gotten this. This is another record. We've had big jumps every month, sort of since Trump's tariffs began to bite, which are far and away the biggest in recent history here. But these are big numbers that are important, partly because of how focused Trump is on them. He talks about tariff revenue nonstop, and it's a sort of real difference, I think, this week from kind of Liberation Day 1.0. He has these bigger tariff revenues coming into point to. He also, I would add, has a growing stock market that has reacted in a totally different way than the first week of trade rhetoric. And so it kind of puts him in a different position. As he put it earlier this week at a cabinet meeting, the big money comes in August 1st. The question, of course, is whether markets believe he's actually going to increase duties as much as he says he is.
Jay, I want to get you in here as well. Listen, as Ben's detailing there, that Trump tariff headlines keep coming in fast and furious. He's keeping up the pressure, Jay. Walk me through how, as an investor, you're thinking about it.
Well, I know what the market's thinking about it. They're brushing this off like this is more bark than bite. But we started this week off very calmly. Okay, we got an extension to August 1st. We're waiting on these letters. The letters got us back to some Liberation Day levels, and what we learned is the market doesn't care. Investors are kind of taking a more cautious approach. But, to Ben's point, the president is negotiating from a pocket of strength now with the market at all-time highs. The fact that he can do this and has seen inflationary numbers remain rather stable and they did not go up as people anticipated makes it more interesting. But it's just the bizarre, okay, we're going after Brazil all of a sudden where we had a surplus with them. That was a surprise. And now today, Canada again. I think we went after Canada 2 Fridays ago. So, to try to predict what the president's going to do next, that is the challenge in itself. But as far as the market goes, I'm very impressed that the market is being able to stay right off all-time highs as we head into the weekend.
All right, Inez, bring you in here as well. To Jay's point, a bit of a retreat today from record highs, but modest. Inez, bring us up to speed on the market action.
Yeah, Josh, it's very modest. I mean, if you just take a look at the NASDAQ, for example, the NASDAQ flipped into positive territory slightly, but still it was positive for part of this afternoon. So we'll have to see what happens in the rest of this hour for trading. A lot can happen in 1 hour. I'm keeping my eye out also on Nvidia, which we have seen record after record for Nvidia. It's in positive territory right now. And I'm also keeping an eye on what's happening with commodities, because we have been watching oil drifting higher. You've got WTI and Brent crude up about around 3% each. Oil is up now for the week. You had the IEA report saying that despite these projected surpluses that are expected for the year, there's still a tight supply in the market. Part of that has to do with seasonality. You've got rig counts week over week that are down for oil. So you have this supply tightness that's happening in the market. But longer term, Wall Street is expecting oil to go lower because it has been on a downward trend. I'm also taking a look at what's happening in the metals markets, which is very interesting. You've got gold that's up. It's up 26% year to date. It's been up today. You've got a silver squeeze happening with silver up to levels we haven't seen since 2011. So silver up 5% today. And then you've also got copper that's slightly higher. I've been watching copper, of course, because the president announced perhaps a 50% tariffs on copper. That's going to have an impact on prices. We have seen copper record amounts being imported into the U.S. ahead of these tariffs, but the street was expecting that tariff would be around 25%, perhaps not 50%. Year to date, copper up 40%. Josh?
And Inez, while we have you, before I let you go here, we did see records earlier. Where's Bitcoin sitting at now, Inez?
Yeah, so we have been watching Bitcoin. It's right now below 118,000. But let me just pull up our Bitcoin charts right now so we can take a look. We're seeing that Bitcoin's up 3.5%, just below 118,000. So a record for Bitcoin. Year to date for Bitcoin, we are seeing that the token's up 25% year to date. It's had a massive rally, and a massive rally, by the way, I should add, also from those April lows. Look, Bitcoin had been in this trading range of around 10,000, very tight trading range. Suddenly it's gone up, it's broken out. What analysts are talking about is resistance around 120,000. Of course, a bunch of catalysts that you have because of this is this breakout. It's part of this is institutional flows into those ETFs. You've also got this regulatory framework. Next week, you're going to have the crypto week in Congress. So that's going to be bullish for crypto in general. But look, when we're talking about crypto related stocks as well, a year to date chart, you can see Robinhood 162% higher, Coinbase also 54% higher. These are all-time highs for these stocks. MicroStrategy up 47%. Crypto on a tear, but the resistance level is expected to be 120,000. Some analysts say that by August, you could be seeing a retest of that resistance level.
So, Jay, I want to bring you back here. You know, as Inez was pointing out here on the broad markets, all right, something red today. You got the SPX, your broad gauge is down about 0.3%. But just give me your take, Jay, on the market moves we've seen today.
Yeah, the market moves today have kind of been lackluster. We're pulling back in some sectors that we've seen some strength in. To me, we continue to see a rotational theme, and the market is really showing some signs of health. When I talk about signs of health, I talk about the stocks above the 200-day moving average. Right now, we have about 60% above the 200-day moving average, 67% above the 50-day moving average. We're not overbought, and those stocks that got a little overextended, those are the ones that are pulling back. The financials, as we go into earnings, a lot of them had a big run. That's where some of the weakness is today. Energy, a sector that was beaten down, showing a bid. So to me, this is just rotation, and this is what you see in a bull market. The headlines, the fireworks will come next week when we kick off earnings season. I'm sure we're going to talk about it a little bit more in the show. But this is healthy rotation, and this pullback is nothing to be concerned about. We're still less than 20 points from an all-time high in the S&P 500, so not bad.
Nez, Ben, thank you so much for helping us kick off the show. Appreciate it. And joining us now, we got Stephanie Lang, Chief Investment Officer at Hammack Berg. The firm has over $25 billion in assets under management. Stephanie, it's great to see you. So I don't know if you were listening to that conversation, Stephanie, but I want to bring you in on it. Trump, tariffs, the headlines coming fast and furious. Stephanie, the president keeping up the pressure there. I'm sure, Stephanie, you're getting questions from your clients about that. What are you telling them?
Well, tariffs are the wild card right now, and really what has been driving the price action really this year. And if you look at backing up 2025, the first half of this year, it was all about tariffs, and a lot of the bad news was priced in. But now we got the tax bill through. And so we're finally getting some good news. But Trump barely took a breath, and now we're back to tariffs. So we are a little bit concerned about where this goes from here. But the nice thing is that the market has really been shrugging this off. And so we're feeling pretty good about the equity markets looking forward.
Why do you think, Stephanie, the market seems to be shrugging it off? Is it because the deadline is it a few weeks out, so folks think, all right, well, I can just kind of put that to the side for now?
Yeah, I think there's several reasons. As one, you've seen Trump really kind of move the goalposts in terms of what he's going to do and when. So I think the market's not so sure he's going to come down hard on this, but we'll see. I think some other good news is that we're starting to hear from companies and how they're going to mitigate these tariffs, and it doesn't seem to be as bad as expected. I think a lot were very worried that this would go right into inflation, right into margins, but what you're seeing is companies pulling different levers so it doesn't hit the margins so hard, and it's really being mitigated. And I think a lot of that also has to do with the demand in the market. I mean, we just heard this week from Delta reinstating guidance. Ives today said demand is good, and it's offsetting the tariffs. So I think that is looking good from a fundamental standpoint. And then lastly, this tax bill is also offsetting some of the worries about the deficit. So overall, I think it's not as bad as expected. Of course, we don't know where Trump will come in at, and so that's a risk moving forward.
And Stephanie, we're about to hear from a lot more companies, right? Got earnings season on deck, big banks next week. What are you listing for during this earnings season, Stephanie, and what do you expect?
Yeah, I mean, the good news is if you look at this year and even pushing out to next year is that we had a strong Q1. Q2 estimates have been cut quite a bit. A lot of analysts and companies took the chance to use tariffs as a reason to lower expectations. So I think we're in a good spot in terms of beating expectations for earnings. We're just at 5%. You look at the full year, we're at 9%, and then we have acceleration going into 2026. So what we're looking for with companies is this really affecting their margins? Are they able to mitigate the tariffs? And what is the bottom line and guidance going forward? And I think, we're starting to get some anecdotal evidence. I mentioned Levi's, we've seen from Nike, Delta, and so far the companies are able to find a way around tariffs. Now, if Trump, doubles, triples from here, but I think he's keeping an eye on the market. He's keeping an eye on the economy. And this is more of a negotiating tactic, but we'll see where it plays out.
Jay, I want to get your thoughts on Q2 earnings as well. We're heading into it. What are you listening for?
Yeah, I think, as Stephanie said, it's all about that guide. We got off to a good start. Yes, the sample size is small with Delta and Levi's, but when these big banks start to come out next week, I think that's going to be the tell. A lot of companies pulled back guidance, Delta being one of those companies. Granted, the bar was lowered in that guide, so I think we're going to have some lower hurdles to clear, and we should start clearing them next week. So the word uncertainty has been the word of the year. Let's hope that goes away. 84% of the companies that reported last year in the S&P 500 last quarter, they used the word uncertainty. So let's hope we get a little more clarity, a little more guidance, and that will keep investors, at least, and analysts especially, a little at ease and can predict or try to predict what's going to come next.
Stephanie, bottom line, given the backdrop, the environment we find ourselves in, how do you want to be positioned here in the market?
Well, I think first and foremost, if this year has told us anything, that trying to trade around these tariffs and policy is very difficult. So stay invested, use these dips to bring up your equity allocation. If you look at where to lean in, though, we prefer to lean into those areas that have the strong earnings growth, which is really those sectors that are fueled by AI, the technology, communication sectors, and those are really driving most of the growth this quarter and throughout the year. But we are starting to see a little bit of a catch up from some of the other names, the other sectors, in terms of the other 493 stocks outside of the Mag 7. So we need that broadening to occur, but right now we're sticking where the growth is.
Stephanie, great to see you and have you on the show. Thank you.
Thank you.
All right, one key headline to get to. Kraft Heinz is reportedly preparing to break itself up. This is according to the Wall Street Journal. Kraft Heinz may split its grocery business, including Kraft products, into a new entity valued at up to $20 billion. The remaining company would focus on faster-growing sauces and condiments like Heinz ketchup. A split could be finalized in the coming weeks, according to the report. Jay, what do you make of it?
Yeah, we're going to be anticipating this one all weekend. We had the Kellogg's deal, and Kellogg split up into cereal business to what was a cereal, and then the candy bar business, and the WLK brand got bought out this week. So it was shareholder value, and right now, Kraft Heinz is 43% off its all-time high. They need to shake things up. The staples have been under pressure. So even if this doesn't come to fruition, this is something that they need to start thinking about, not just at Kraft Heinz, but at some of these other bigger brands. Anything to enhance shareholder value will be critical going forward.
Yeah, the Journal does remind us too, Jay, that Kraft Heinz said in May it was continuing to evaluate strategic transactions to unlock value, and that it had said Buffett's Berkshire Hathaway would no longer hold board seats at the company, and someone said, okay, maybe that was paving the way for some significant changes. So we shall watch and we shall see. We are just getting started here on Market Domination. Coming up, Nvidia has become the first ever $4 trillion company, and their CEO Jensen Huang is taking meetings with President Donald Trump at the White House. We're going to dive into the chip giant on the other side with, of course, the one and only Dan Ives. There he is, the man himself. Stick around. Much more Market Domination still to come. Nvidia CEO Jensen Huang met with President Donald Trump at the White House just days before a planned trip to China for the chip designer's chief executive. For more on the latest from Nvidia, the only member of the $4 trillion market cap club. Let's welcome in now. Got Dan Ives, Wedbush Securities Managing Director, Global Head of Technology Research. Dan, it is good to see you, my friend. I love the look today, Dan. It does look like, you know what it looks like, Dan? It looks like I'm interrupting your tea time. So I'm gonna get through this interview. We're gonna get through it real fast. I feel like you got places to go. Let's start with Nvidia, Dan. Nvidia CEO Jensen Huang, he's on the way to China. We know there, Dan, he can't sell his latest and greatest chips, right? And it's costing his company a lot of money. I'm curious how you think this all plays out. Does he get Trump to reverse course? Does he find a workaround? What do you see ahead?
I mean, he's not going to the White House just to have lemonade with Trump. I mean, the point is, our view is that the restrictions when it comes to China, a lot of that ultimately will, at some extent, be lifted where Nvidia can sell their chips into China. Remember, I mean, they're not going to just give $8 billion a quarter to Huawei on a silver platter. And it's all part of this negotiation that you see. But there's only one chip in the world fueling the AI revolution, and it's led by the godfather of AI, Jensen Nvidia.
If he can't sell his latest and greatest in China, Dan, how does he make that up? Could demand from the sovereigns, the Saudis, the UAE, could that make it up?
Look, that can make it up. And I still think Street's underestimating growth by 20-30% in the next few years. But you do not want to give China just away to Huawei. I mean, that where Nvidia can't touch it. And they know, and Jensen knows, that continues to be the biggest market incrementally that they're going after besides the US. And it's all part of this negotiation. You cannot just hand that business to Huawei. And that's why, look, it's all part of this high stakes negotiation. But there's only one chip in the world that's fueling it. And Trump knows a big poker chip that he has in negotiations is Nvidia.
I'm sure there are some viewers, Dan, this week, when they saw Nvidia hit that milestone, right? They might have thought, hey, I missed my chance, I missed my opportunity. I know you feel differently. What are the catalysts that keep this one, in your opinion, moving higher?
I think 5 trillion and beyond are next, because it's my view, we're in a golden age for tech. It's led by Nvidia, but it's speaking to the AI revolution. I mean, behind the velvet ropes, they're going to let Microsoft into the $4 trillion market cap club as well. When it comes to Nvidia, this is still just the beginning of a 3-year tech bull market, and it's being led by Jensen.
Let's switch gears to another name I know you like, Dan, and that would be Tesla. You like the name. You don't seem happy with Elon Musk and how he's spending his time. He's right back into politics, right? Full speed ahead. He's going to create this American political party, this new political party. You laid out changes you want from the Tesla board, Dan. You say new pay package for Musk to 25% voting control, guardrails for the amount of time Musk spends at Tesla, and oversight in political endeavors. Does any of that actually happen, Dan? What odds would you give it?
Yeah, and obviously Musk didn't like, what we laid out. I believe the odds of that happening are ultimately just some combination more than 50% in terms of that. And especially when it comes to 25% voting right, what I view as an XAI merger, to me, that is ultimately sort of the next stage to where we see this all heading.
I have to ask you, Dan, only because we're showing the post there. When you lay this out, Elon Musk says, shut up, Dan. So the owner of X, on X, guy's worth $400 billion. He tells you to shut up. You saw that, Dan? What did you think and feel when you saw it?
Look, I mean, I knew Elon and knowing, for 20 years and him and following Tesla and being such a big support, he wasn't going to like it. But again, friends could disagree, right? And so hopefully, over the coming months, we're able to work out our differences. But as one of the biggest supporters of Tesla, we needed to do that. Given our view, that's what the board needs to do to ultimately move this forward. Tesla's going into its biggest stage of growth ever in autonomous and robotics. Musk needs Tesla, and ultimately the biggest asset continues to be Elon.
So you had your criticism there, Dan. It's important to note you remain bullish. You tell your clients are at Wedbush, they ask you what to do with them. You say, listen, this one's an outperform. It's still a buy. What would you need to see, Dan? What would have to happen for you to rethink that rating?
Look, I mean, to me, it just continues to sort of be, this is going to be one of the biggest winners in AI along with Nvidia. So for me to get bearish, I don't see it relative to everything we see in front of us when it comes to autonomous.
Finally, Dan, another ticker. I got to get this one in. Let's talk Apple. Another name you like, right? The team at Lightshed made some news this week with a provocative report. I know you saw this, where they were asking, is it time for a new CEO at Apple? You know that company well. You know the CEO well. What's your response to that question?
Cook continues to be the Hall of Fame CEO. He will lead Apple, I believe, at least the next 5 years. That said, AI revolution can pass Apple by. I believe the time's come for them to make an acquisition in terms of Perplexity. And I think that's the difference. It's Cook reading the room on this next chapter. Because look, you miss AI, that would taint a big part of his legacy if you miss the AI revolution.
That would be a hard shift to do an acquisition like that, Dan. I mean, Apple does do, acquisitions, but traditionally they stay small. I think the biggest one they ever did was Beats for $3 billion. What kind of odds would you give that they would make a move? Perplexity, I think, valued at around $14 billion, I believe.
I believe they don't have a choice. They have to do a deal. I get the DNA of Cupertino. We could build it better than them. But it comes down to, it's like a baseball player in a slump. You got to change your bat, right? Mantle, Cobb, Garrett. You go back, Babe. They change their bat. Cook, it's time to change. Need to do Perplexity, in my opinion.
Finally, Palantir, Messi of AI, as you put it, Dan. You raised your target. You go to 160. You're doing your checks, and obviously you like what you see. What are you seeing? What are you hearing?
The AI revolution is being led by Nvidia and Microsoft, but Palantir, they're going to be one of the core players. I think it's $1 trillion company in the next 2 to 3 years. And look, the haters will hate, but it's just the beginning of the use cases playing out on enterprise, on government. That's being led by CARP, and that's why there's only one Messi of AI, and it's PLTR.
What do you say to the skeptics, Dan, the bears, who will say, listen, and they've been on this show, and I've asked them, they'll say, listen, I like the tech, they'll tell me. I like the fundamentals. I don't like the valuation. It's an irrational valuation is how they'll put it. They'll say that at these levels, the risk reward does not look attractive. What's your response?
The bears are in hibernation mode, and in their spreadsheets, they can see AI. And if you focus just on valuation, you missed every transformational growth stock the last 20 years. And Palantir, they hated 15, despised it 50, yelling at 100. It's going to continue. Again, it's like right now, this is being what I view as one of the best AI plays in the world.
I know you tell your clients, you say this one on the path, you argue, to become the next Oracle.
It's the next Oracle, the $1 trillion path. They're in a left lane, a Ferrari going 100 miles an hour. A lot of the competition's in a minivan going 45 miles an hour right lane.
Dan, always good to see you. Always good to have you on the show. Thank you, sir.
Thank you.
Coming up, Netflix earnings on tap next week. We're going to speak to an analyst on the other side to preview those results. Stick around. Much more market domination. That's still to come. Some big earnings on deck, including Netflix on Thursday. The streaming giant is on a strong run to start the year. Our next guest recently raising his price target on that stock to $11.40. Joining us now is Eric Sheridan, Goldman Sachs Research co-business unit leader of the TMT Group. Eric, it is great to see you. So let's start right there on Netflix. Earnings on deck July 17th. Interested to hear your expectations with a stock, by the way, that has been on a run, Eric. It's up about 40% this year.
Well, the stock is a reflection of the business. They've been raising price. They've been knocking the cover off the ball with respect to content. We would expect upwards of a 3 to 5% beat on revenue this quarter, and a lot of that is going to drop to the bottom line. So you were still very much in an earnings revision positive cycle for Netflix. You've got a content tailwind. You've got a competitive tailwind. So there's a lot to like about the business.
It sounds great, Eric.
Yeah.
So why the neutral?
Our neutral is a reflection of the valuation. You can buy a lot of stocks on my coverage list, including many of the biggest companies in the world, for well below 40 times one year forward earnings. It's not a negative call. We'll have a sell rating if we're negative on things from a risk reward skew. But we think this is right around fair value in the 1,200 plus or minus range.
I've always thought one real quiver they have, Eric, is just the pricing power. Meaning Netflix could keep raising prices on Josh Lipton. I'm going to stick with him. I'm loyal. I'm locked in. The content's great. What's your view on that?
I can agree with that. That is already modeled in our work going out over the next 5 years. Is in developed countries, we already have an assumption that they're going to likely raise price somewhere around mid-single digits on an annualized basis. So prepare for your subscription increases because they are coming over the next 5 years.
Evercore's Mark Mahaney, well-respected, well-known analyst like yourself, Eric. Here's what, he likes Netflix. He's got to outperform. And I saw this morning, here's what he told his clients. He says, we view Netflix as one of the least risky stocks this quarter. He talked about it, the street's Q2 revenue, operating income, EPS estimates, called them reasonable. And he said Netflix has a very consistent recent track record of exceeding its revenue and operating income guidance. Your response to Mr. Mahaney?
I think that's all relatively fair. We previewed Netflix last week. I'm not going into this earnings thinking there's going to be anything negative on the operating front that would shock folks. I think after the run it's had, which you highlighted in the lead-in, I think it just becomes a question of, is that where the incremental returns are going to come in your portfolio on a going forward basis? You've already made the 50% plus return year to date.
Final question on Netflix. In the streaming wars, is that fight over? Do they have the gold and everybody else is just battling for second place?
I think they won the war of the last 10 years definitively. How TV and movies were made, how TV and movies were distributed, they won. I think looking out over the next 5 to 10 years, what's interesting to me is when I look at the media consumption habits of my teenage son, it's YouTube, it's Reels, it's TikTok, it's video games. He doesn't like sitting down and watching a 2-hour movie with his parents. So they are going to have to continue to evolve and shift the strategy over time to meet where the media consumption habits go. But they definitely won the war that we're coming out of.
My 6-year-old, it's YouTube. All day, all night. Let me switch gears here. I'll talk about a name you like, which is Alphabet.
Yep.
One headline I'd love to get your take on, and we talked about on the show, was OpenAI's browser. Reuters said it's on the way, it's launching. I think they said in weeks. If I see that headline, Eric, how should I think about that as a Google investor? Am I worried?
I think there's a lot of competition risk and even judicial risk that is in Alphabet stock right now. We've been debating Judge Mehta's ruling and the remedies from the search antitrust trial with investors for the better part of the last 18 months. On some level, a lot of negative outcomes are already priced into Alphabet. I don't have any edge on when OpenAI will launch a product like that, but it has been rumored before, and we're still sort of waiting for it. I would fully expect that companies that have an AI agent that are trying to change computing habits at their core will launch similar browser-like products. The problem is changing consumer computing habits is very, very hard. Even with the rise of ChatGPT over the last 2.5 years, most data we look at would say you're using your mobile phones within 90 to 95% of the same way you were 2.5 years ago. So consumer computing habits change over long periods of time. Competition is coming. There is an interesting dynamic with Alphabet that you have a antitrust case that's coming to an head about whether they're an anti-competitive force, and yet at the same time you have competition on the rise. There's a real push-pull in that and how to think about Alphabet over the next 12 months.
So Jen, I want to get you in as well because I know Eric's a fan, you are too.
Yes, without a doubt. It's one of the Magnificent Seven, yet it's down 4.7% for the year. And it has that cloud of uncertainty because of litigation, because of search competition, but there are a lot of positives there. We talked just now about YouTube. Everyone watches YouTube, every younger generation. What do you see as the positive catalyst and what's been holding it back? And how do they clear that hurdle to finally get back to all-time highs at 205?
Yeah, so we just put out our digital ad preview overnight. I would say there's 3 things you have to watch for in Alphabet. Number 1, the consistency of search results in light of the competition. We raised our numbers overnight. We think search is going to beat. Consistency of high single, low double-digit growth in search in light of what's going on with ChatGPT and others, I think climbs a wall of worry. Second, you have to get the Judge Mehta court ruling behind us. You have to flip an unknown variable into a known variable. It is very difficult to allocate capital behind risk. You've got to flip that into a known variable. The last thing is continued innovation. Most investors I talk to globally want to own YouTube, they want to own Google Cloud, and they want to own Waymo. So there's 3 major pillars that they want to own inside Alphabet. They just have to get comfortable with the search dynamic.
Final name I want your thoughts on, Eric, would be Uber. What a run for that name. It's up about 60% year to date. You tell your clients it's still a buy. Yep. So what are the catalysts that keep it moving higher?
So coming into the year on this channel, we announced that was our top pick for 2025 in December. It's similar to where Alphabet is today, has climbed a massive wall of worry. In December, most investors were of the view that if Waymo didn't do operational damage to Uber, that Tesla was going to do operational damage to Uber, and I think we're in a very different spot now. What keeps it going? Partnerships with Waymo. The successful launch of a partnership where Waymo inventory is inside the Uber app in Austin has gone as well as we could have expected. And now the Atlanta market has a similar arrangement between Waymo and Uber. High teens, low 20s mobility growth. Again, sustained growth like that really can wear down the bear narrative in a stock over time. And it's not that expensive. They're returning capital to shareholders. They continue to talk about being a mid-teens or better grower, and EBITDA growth is going to exceed that.
You make a compelling case, Eric. Before I let you go, though, for viewers, before they all pile in, what are the risks I would need to think about?
Uber, there's 2 risks. Over the longer duration, you do have to worry about how AVs are going to change the landscape. So one of the central themes we talked about was the duration of AVs playing out was going to be a lot longer than some of the investor fears I had heard coming out of last year. But you're still going to get a lot more AVs on the road in the next 5, 10, 15 years. And how that alters the supply-demand dynamic is a long duration risk. The short duration risk is the consumer. These are expensive services. There are alternatives. You don't have to take a nice car from point A to point B. You could walk, you could take a city bike, you could take the subway. So they have to compete against consumer spending habits. And that's the more shorter term dynamic you have to watch from a volatility standpoint.
Eric, it's so good to see you, especially on set. Thank you for your time and those picks.
Thanks for having me in.
A lot of focus on the Fed from Wall Street and what the interest rate path forward will be ahead of July's FOMC meeting. Yahoo Finance's senior reporter, Ali Canal, joins us now with our investor playbook. Ali.
Yeah, Josh, strategists have told us that it's the million-dollar question right now. Will the Fed cut rates in September or wait even longer? Goldman Sachs now expects the first rate cut in September. That's up from its previous December projection, citing weaker tariff effects and a cooling labor market. But not everyone's buying that timeline. Some strategists are warning that the Fed may sit tight, with inflation risks still lingering and tariffs adding new uncertainty. Investors are going to get their next big test with that, with the release of the June CPI report out next week, and that has been trending lower on a month-over-month basis, but any upside surprise could shake those rate cut bets. Here's what some on Wall Street told us this week.
Tariffs, which has surprised a lot of people, for sure. But that's happened because the service sector inflation, that's come down. Inflation has come down generally because of oil prices staying lower as well. But the Fed is focused on inflation because they're worried about goods inflation, and that will accelerate it.
And I think the Fed is going to continue to take a wait-and-see approach. Right now, there's a 30% odds of no rate cut at the September meeting. And I'm not predicting a Fed rate cut in September either. I think they're going to stay on the fence as long as they possibly can.
And the last thing is the fact that the Fed may sit on their hands longer than what's currently being priced into the markets. That September rate cut is getting pushed out potentially to November or December, October or December. And if that happens, that means that some of the companies that don't have as many offsets to the tariff pressures that you're going to see may continue to struggle in this environment.
And sources tell me to expect some volatility if we don't get that September rate cut, especially since that's what markets are currently pricing in. But the good news here, Josh, is that we do have other positive catalysts within this market earnings. For example, that's going to be a very important factor that can keep this rally going. We've seen solid results so far from Delta and Levi's, and we have a heck of a lot more companies reporting next week. So wait and see for that, and also wait and see for the Fed for the time being.
All right. Thank you, Allie. Well, the pharmaceutical industry bracing for one of its most financially significant patent cliffs in over a decade. We'll discuss the impact on the other side. Stick around. Much more market domination still to come. The pharmaceutical industry is bracing for one of its most financially significant patent cliffs in over a decade, with multiple blockbuster drugs set to lose exclusivity by 2030. Our team coverage here to break down the impacts these could have on the industry. Got Jay Woods, and we've got Yahoo Finance's Anjali Kamlani. Anj, we'll start with you. Why don't you set it up for us, Anj? What are we looking at?
We're looking at a number of the quote-unquote biggest names, and I say that because they are still part of the big pharma club, but not necessarily ones that are favorites or they have sort of lost their steam a little bit, if you will. We're looking at Merck, Pfizer, among the biggest ones, J&J as well, Bristol Myers Squibb, all of these names who have been sort of the behemoths of years past. There's questions about what their future looks like because of these patent cliffs toward the end of the decade. We know Eli Lilly sort of went through their period a few years ago. So what Lilly faced before, and it's now clearly made such a huge comeback, that is what everyone else is going through right now. It's the pain of growth and questions of, what do you got for me next? And that's the question Wall Street is basically posing right now.
Jay, how are you thinking through it?
Yeah, I mean, people don't realize the significance of this cliff ending. You can look at Merck as the perfect example. Viagra was the big drug back in 2000. Well, guess what? It peaked when Viagra was no longer its own exclusive drug. It was generic. And now we're seeing it come to fruition. You mentioned J&J. That drug is Stelara. Mentioned Bristol Myers, Eliquis, and Opdivo. Eli Lilly did well. Why? Because they had, as Donald Trump said, the fat shot. His words, not mine. Anyway, what we saw this week was very interesting because Merck did a small acquisition, $10 billion. It's not small for you and I, but they took over a UK company called Verona. Verona. I'm thinking Corona Friday afternoon. But it's a COP drug. They're looking for exclusivity. And I think this could heat up M&A activity. The biotech sector starting to catch a bid, starting to turn around. This could be the beginning of something as we head into earnings season as well.
I don't know about heating up, though. I would pull that
warming
back.
Up?
Just warming up might be.
Yeah.
It is lukewarm because, I mean, yes, it's a big acquisition. We also saw Pfizer make a number of huge acquisitions, $43 billion for Seagen, right? And in that, you saw the potential for blockbusters to fill that gap for their cliff. Keytruda is a nearly $30 billion revenue per year, and they can't fill it with one acquisition that way. So I think that maybe maybe the companies haven't thought in time to fill the gaps.
Yeah.
And it's only really when Wall Street started asking the question, when investors started asking, wait, you have a patent cliff coming up, right? What are you doing about that?
Exactly. Well, I'm looking at it from the trader point of view. Yes, it's not heating up by any margin, but when it's ice cold, you have to turn on the heat. So I think we're starting to get some green shoots, I hate that word, green shoots, but we're starting to see some activity there where people are looking, okay, what could be the next catalyst? And I think M&A is the best one, because you look at companies like Pfizer, they haven't really come out with that next big thing. They had COVID, and we saw what they did, and COVID's over. So we'll see what is next.
As a trader, J&J earnings next week. Walk me through that setup.
Oh man, I wish it's a Dow stock. It's been going nowhere in a neutral pattern between 138, 168. Near term, you may get a nice little rally up to the upper end of that channel. But what will be the catalyst to break that stock out? For an investor, if you're looking for a great long-term play, you need this stock to really give you a couple quarters of activity. I don't see it. So it's one I would stay away from. But if you like good, smart, safe, dividend plays in the Dow, then I give you Johnson & Johnson.
That's the trader take. Anj, what are some of the questions you would have ahead of that trade?
Yeah, I think there's still the focus on the talc overhang, right? That has also been an ongoing problem for J&J. They've been trying to get over it, but it's still sort of in their path. And then also the fundamentals, to your point, like what are they doing? Where are they deploying the capital? What are they looking at? They're going to have strong numbers no matter what. MedTech has always been one of those that's fluctuated for them over the years. I've covered that in the recent past. We're going to see where that goes, especially with tariffs in play, because MedTech has been hit by tariffs already. That's not something that got cut out with the pharma tariffs. And so that's one area that I'm also going to be looking at. But to your point, it's one of those, I think the dividend plays is how you'd sort of categorize these big pharma companies that have been fun for now, and questions remaining, J&J included.
We hit J&J, but let me know, Jay, are there certain sectors that you find more attractive here?
Well, I did mention the biotech sector. I think that the risk-reward setups are there to enter it. I wouldn't, jump in with a large position, but I think there is upside potential there. And then when I was looking at the individual charts of the names that we've talked about, Merck has finally broken that downtrend. Yes, maybe it was the catalyst of this deal this week. I don't think that's going to be game-changing, but it's showing investors that, we're going to put capital to work to try to turn this around, to try to find that next big thing. So from a risk-reward perspective, Merck just broke a 2-year downtrend, has a lot to reverse. Just to get back to its 200-day moving average, I think an investor could make a nice profit over the next 3 to 6 months if they got into Merck.
All right, thank you. Thank you both. Thank you, Anj. Appreciate it. Let's check in on one of our top trending tickers, looking at CoreWeave. That stock is sinking, despite Argus initiating that stock at a buy and a $200 price target over the rapid growth of the company. So Argus Research, Jay, they start CoreWeave with a buy. They like what they see, target 200. They say the company has grown more rapidly than expected. They say primed to build on its position as a leading provider of AI infrastructure. Growth is keeping pace with its share price appreciation. We know this, the move this one has made since going public earlier this year.
Yeah, the move has been astronomical. It's down 30% off its recent high, and that's only over 2-3 weeks right now. So this may give investors an opportunity to buy. It actually has a 50-day moving average. It's been out for about 50 days, and it's coming right into it. So to me, this pullback, for someone very optimistic in the name, this is a great entry point. Here, down another $5, but you put it away. The sector this week has been getting hurt. There have been a lot of downgrades in software. So for me, that's part of the story. And then you look at the other big IPO, not related, but Circle, that's also getting hit today. So maybe people are just going into the weekend, taking some off the table and looking to, ramp up something, because guess what? The IPO pipeline is starting to pick up again. Next few weeks, I think we'll be sitting here talking about the Figma IPO or whatever next IPO is rumored. Where StubHub had an S1, they pulled it back. Maybe they come back to market. So I think that people are just kind of enjoying this for a little while, but people looking for an opportunity to get into CoreWeave who missed it, I think we've given them an opportunity here and maybe a few points lower. You
mentioned that IPO market. Interesting, Jay, because I'll have different opinions from very smart guys on that topic. Yeah. Some will say, listen, yes, expect a rush of listings. Yeah. Right? Market's new highs. Other guys have come on and said, I don't know how long the window's going to stay open. The reason being they just feel like there's a lot of uncertainty left. They still have questions about the economy. They got questions about Trump's tariffs. Where do you come out on that?
Yeah, I've been one saying the pipeline has been robust, which is the term we like to use, for quite some time. There are companies dying to get out there, and now
it makes you sound so smart.
No,
when
it
you say
does.
robust,
Robust
right?
is just such a great word. But no, there are a lot of people that have filed their S1s that have been waiting for an opportunity. And you said it. What's better than new highs? What's better than a few IPOs that have gone out, right to the
welcome
moon
wagon, right?
Yeah, and they've held on to those gains. So like eToro did well, Webull not so much, but there are opportunities here. When you're seeing, we got through the tariff tantrum, and now we're part 2, but part 2 is not really having the impact. It's not really moving the box office like part 1 did, which is a good thing for investors. So I think that we're set up for the second half to be strong, but I have been wrong on that one before. I think, though, the recent IPOs really give investors a lot of hope that it's coming, because we know the retail investor, one, they bought the dip, so kudos to them, while the institutions are on the sideline, and two, they're looking for new names to get into, as we've seen with these recent IPOs.
All right, thank you, Jay.
Yep.